Hello, my name is Melissa Golding, and I'm the press officer for the Group of 30. I'd like to welcome all of you to today's live press conference and webinar launch of the G30's new research report, Non-Bank Financial Intermediation and Financial Stability, a Perfect Storm in the Making. We will begin the webinar with opening remarks from the co-chairs of the Group of 30 Working Group on NBFI Reform, Mr. Agustin Carstens and Mr. Klaas Knot. Following the project co-chair remarks, we will hear from Project Director Stijn Claessens. The remainder of the webinar will be dedicated to audience Q&A. Please note that this report and presentation represent the views and recommendations of the Group of 30's Working Group on NBFI Reform and not the Group of 30 as a whole. While the report reflects broad agreement among the Working Group's participants, this does not imply agreement on every specific observation or nuance. Working Group members and the project director participated in their personal capacities, and their participation does not imply the support or agreement of their respective public or private institutions. Today's speakers are likewise participating solely in their personal capacities. I'd now like to introduce Agustin Carstens, co-chair of the G30 Working Group on NBFI Reform. Mr. Carstens?
Thank you very much, Melissa. Good morning, good afternoon, good evening. Let me welcome all of you to this G30 event where we will present our latest report, NBFI and Financial Stability, a Perfect Storm in the Making. Accompanying me is Klaas Knot, that you know very well, past governor of Netherlands Bank and post-chairman of the FSB, who co-chaired the working group with me, and Stijn Claessens, who is the project director. Let me also thank the other members of the G30 that participated in this working group. In the steering committee, Bill Dotley, Axel Weber, Arminio Fraga, Yi Gang, and Gail Kelly, in addition to Andrew Bailey, Christian Noyer, and Thomas Buberl. I thank also the G30 staff that made possible our endeavors, in particular Desiree Maruca and Maria Cueto. So let's get down now to the report. I will give an overview, and then both Klaas and Stijn will go deeper into the details. To understand why the G30 took on this project, we must start by looking at the sheer scale of the shift in our global financial system. Since the 2008 crisis, the center of gravity in finance has moved. NBFI is no longer a peripheral shadow sector. It is now the majority of the system. By the end of 2024, NBFI assets reached a staggering $260 trillion globally, accounting for more than 50% of financial intermediation. This amazing evolution has not been only in absolute size of NBFIs. There are other dimensions that have evolved very dynamically in instruments, breadth and complexity of markets, proliferation of new intermediaries, geographical reach. And these developments have not been always transparent, making them difficult to follow and assess. While this transformation has brought benefits, diversifying funding sources, broadening access to finance, and fostering innovation, it has also introduced systemic risks that we believe are not yet fully understood or managed. Broadly speaking, and of course, as I say, Klaas and Stijn will elaborate, our analysis identifies several fault lines within the NBFI sector. First, liquidity mismatches. Many NBFIs combine illiquid assets with runnable liabilities, like the ones generated by repo financing. In times of stress, this leads to a dash for cash, where massive forced fire sales could proliferate, generating cascading disruptions in financial markets. A key source of concern here is that core bond markets could be majorly disrupted, causing a crisis-like situation. And this is not just a theoretical speculation. During the last years, we have witnessed multiple episodes of massive market dysfunction and broader financial instability, which needed to be contained through large-scale central bank liquidity interventions, which clearly are undesirable. The second fault line I would like to refer to is hidden and high leverage. While banks are strictly regulated, certain NBFI segments, particularly hedge funds, operate with very high leverage, often using short-term funding that can unwind abruptly following market shocks. This magnifies solvency and counterparty risks. Moreover, the banking system is deeply interconnected with the NBFIs, not only as a deposit taker, but also providing financing, oftentimes through credit lines. These deep leveraged interconnections of the NBFIs with the banking system is an important source of concern. To some extent, some segments of NBFIs have facilitated the migration of credit risks out of the banking system post-GFC, but this is not the case for liquidity risk, which remains heavily concentrated in the banking system. The bottom line is that banks and NBFIs are now so deeply interconnected through credit lines and derivatives that a non-bank failure could spread systemically. Given these underlying conditions, many of which are structural, a perfect storm scenario might be brewing for several additional reasons. First, the global financial system already exhibits significant vulnerabilities. Case in point are the recent events in the private credit markets. Second, past and ongoing policies, in particularly highly expansionary fiscal and monetary policies in advanced economies, have encouraged excessive risk-taking. Third, economic and financial uncertainties are currently elevated, reflecting shifting geopolitics and increasing fragmentation in trade and finance. Together, these factors make global financial market stress far more likely. Moreover, the complexity of NBFIs and its opacity not only hamper timely systemic risk assessment and complicate the identification of critical vulnerabilities, but also render stress episodes harder to contain. Thus, more preventive and remedial actions are needed. Precisely, this report proposes a set of targeted policy measures to reduce the risks identified, in particular the risks of adverse liquidity spillovers and solvency events, and to better manage these consequences should they occur. By being preemptive now, strengthening regulation, upgrading market infrastructure, and internalizing these risks into our policy thinking, we can preserve the many benefits of a diverse financial system while ensuring it is resilient enough to withstand the next storm. I will now pass over the floor to Klaas for him to expand on this overview and discuss in more details the specific policy actions required. Klaas.
Thank you very much, Agustin, and also thank you for providing me the opportunity to speak a few introductory words. I wanted to complement what Agustin was saying by spending a little bit of time on the question, why has progress in this area been so difficult so far? Because, of course, this is not the first time that we discuss NBFI vulnerabilities. And in some ways, the emergence of these vulnerabilities has also been the byproduct of our own success in increasing the resilience of the banking sector after the global financial crisis. After that crisis, we rolled out a financial reform agenda, which was mandated by the G20, which was shaped by the Basel Committee jointly with the Financial Stability Board. And that had a strong focus on banks and on systemic risks. And it was highly successful. It transformed the banks from being big shock amplifier during that crisis into shock absorbers that we've seen at work during the more recent bouts of financial market turbulence in the 2020s. But it also gave rise to something of a waterbed effect, that some of the risks migrated outside the banking sector, that we saw growth of something that we initially called the shadow banking sector. And then later on, we reformulated that into the non-bank financial intermediation space, which is, of course, a better definition, as it is not just about sort of banking activities going outside banking. It's a much broader space, and it's a very diverse space, as I will argue, as is highlighted, for instance, by growth in the private credit space, the shift of the function of market making more outside the banking sector toward fast money investors and the like. And what it also did is, of course, it created an unlevel playing field between the resilience in the banking sector and the resilience in the non-banking sector. So to respond to that, the G20 asks the Financial Stability Board jointly with IOSCO to come up with a work program to strengthen also resilience in the non-bank financial intermediation space. And that was basically a roadmap that consisted of two essential strands. The first was to increase the resilience of major players within the NBFI space. Think about policy proposals to enhance the resilience of money market funds in 2021, or think about addressing structural vulnerabilities of liquidity mismatch in open-ended funds, which was completed in 2024. That was one strand of work. And the other strand of work focused on a couple of cross-cutting issues in the NBFI space. For instance, issues around the liquidity preparedness for margin calls, which in the stress episodes proved to be one of the biggest amplifiers of stress throughout the system. Also on focusing on leverage in NBFI, because at many of these episodes also leverage came to the fore in pockets where we had not expected it to come to the fore beforehand. So it begs the question, the recommendations are there, but why has the implementation of such recommendations been so uneven across countries? And I think there are four aspects worthwhile taking into account here. The first is that, of course, NBFI is a much more heterogeneous space than banking. So the concept of resilience, for instance, is more complicated and is also different in different parts of the NBFI space. There's also less agreement on data, on sort of what are the most important data, which data do we need, who needs to produce this data, and to whom needs that data being reported. Also on these matters is less agreement in the NBFI space than in the banking space. Secondly, as a consequence of this larger heterogeneity, regulatory powers are also more dispersed. In many countries, you have separate authorities for market regulation, trading venues, CCPs, and the like. And that is particularly relevant, again, for instance, when it comes to liquidity preparedness for margining, which, again, as I said, is one of these big amplifiers in stress scenarios, liquidity stress scenarios, these spikes in liquidity demand that we've seen at various occasions. And thirdly, financial stability as a public policy objective is probably less ingrained in the securities world, in the asset management world, as it is in the banking world, where it is part and parcel of the prudential thinking that is inherent in banking regulation, where micro and macro are typically seen to be in each other's extension, whereas in the security world there is more focus on investor protection, on fair and orderly markets, which are also laudable goals, but I think that are a little bit more distant from financial stability. Now, and then a final question, and then I'll hand it over to Stijn, is of course that this level playing field that is there between banks and non-banks, there is not always agreement also among the major players in the world how this level playing field should actually be leveled again. Whether it should come from strengthening resilience in NBFI, or maybe it should come from the other way, lowering a bit the resilience in the banking sector. Now, it will not come as a surprise to you that as former chair of the Financial Stability, I'm of the strong opinion that actually the playing field needs to be leveled by increasing the amount of resilience in the non-bank sector to the level where it is in the banking sector, because I think the paper as it will be presented by Stijn offers a lot of convincing arguments that this is an area where systemic risk can actually build and can also create the kind of turmoil that really would be very, very costly in terms of financial instability, in terms of economic output losses, in terms of social costs of financial stress and the like. But for that, I'd like to hand over now to Stijn, who can talk about this in much more detail.
Thanks very much, Klaas, and thanks very much and Augustine as well for this introduction. I'm going to share some slides with you on the topic. The issues that Klaas and do you see my slides at the moment? The issues that Klaas and Augustine have raised are about the growth of NBFI and the risky forms that have been growing much faster. I want to cover that very briefly. I want to expand also on the vulnerabilities that are growing next to the NBFI. There's a lot of other issues to discuss here, but there's a lot of vulnerabilities in the system building up in the last few years. Crises are hard to predict, but we also have a lot of questions on the resilience of the system now. And lastly, and most importantly, I spend most of my time on the policy responses and give you the details that we recommend. So I think this already mentioned by Augustine, the growth has been very rapid. I want to just mention the last point here. Besides the total size and the share being much larger than it used to be, the NBFI grew about 50 percentage points more in GDP terms than the banks did since 2011. That gives you a sense of how much more important that is. The growth has been very large in the risky forms. We go over the FSB data that do this in detail. The other investment funds include private credit and hedge funds, and they've been growing the fastest in 2024 and in the last few years, above historical level, faster than the period between 18 and 23. So we have risk building up quite a bit in these forms of NBFI. Now we have many benefits. Augustine mentioned some, but we're focusing on the risks here: liquidity and leverage. This is a very succinct summary in the report of a table: leverage column, liquidity risk column. And then there's the third column, which is the spillovers to the main banking system or the core bond markets. And that's where I want to focus on. I'm going to leave this chart for you to look at later. I'm going to go quickly through why is leverage a problem. We cannot expect losses, default related to leverage, to be well absorbed in NBFI. The risk sharing mechanisms are very good. The investors are used to absorbing losses, whether it's the pension funds or the hedge funds. And it's also true that the NBFI is less critical to payment and system and systemic stability in a general sense. But there have been these spillovers, and just a few examples to make it clear. Archegos and Greensill were large defaults that affected core banks. Today's private credit, we'll talk more about that. The GFC, as Klaas mentioned, was a very bad case of NBFI spilling over, both on the asset side of the banks, losses on their loans to the shadow banking system, but also on the funding side, not being able to get resources or guarantees paid out by, let's say, AIG. Liquidity is then often the symptom, and as Augustine mentioned, it's a symptom because we have moved credit risk to the NBFIs to some extent through the regulation, as Klaas also mentioned. But liquidity is something that still comes back as at least a symptom, and we see that today, and this is why we need the buffers in the banks. Now, liquidity we'll go over as well in detail in the report. The core issue is here that liquidity cannot be met by the NBFIs itself. They don't have the ability to generate liquidity like banks do, nor can they get it from the central bank. So when investment funds run down their buffers because of redemptions, they have to scramble for liquidity and they may not get it from the banks. When hedge funds abandon their trade because of some shocks, liquidity dries up because there's no alternative. And the margin calls, which quantitatively are very important, cannot be met by the NBFI either. So then it spills over by definition to the banks or to the core bond markets where you see the dysfunction happening, as we have seen in many cases. I'm going to give some examples of those. then the central banks have to intervene. And here the problem arises that you cannot intervene indirectly very well. You can lend to banks, but they don't tend to lend it on to the NBFIs. They're reluctant to lend in general to these asset class at that point in time. So you have no way to resolve it but doing asset purchase as a form of QE, which helps you support the asset prices, but it's a very blunt tool, not targeted. It doesn't come with conditions. There have been many of such cases on the liquidity side. This is a long list. You can go back to small hiccups in September 2019. You can go to the big hiccup in March 2020 with the COVID, 22 with the invasion of Ukraine. We saw the gilt crisis. I'm leaving it here for you. It is a global phenomenon. Emerging markets have suffered from it as well when the spillovers from NBFI has hit a few countries and they had to respond. And there's also been the carry trade that is partly liquidity issue from the NBFIs. Stresses are hard to predict, so we're not here to tell you that there is a crisis coming around the corner. And it's an issue about vulnerabilities being very high. This list here, we have a large increase in sovereign bond issues around the world, and the report gives you the data. All of that is being financed increasingly so by NBFI. During a period of time when QE was in place, the central banks were giving the financing, but that period is over. There's a growing importance of NBFI in cross-border flows, which gives a much higher asset price correlation than we've ever seen before. And the large hedge funds, as I was mentioned, have high leverage. This is a leverage that can go up to 200 or more because the haircuts in that business are very small, 50 basis points or less. And then as we mentioned, the private credit is closely related to the banks, but also to the insurance companies and the like. So there's a lot of intra-linkages too. Private credit, not necessarily systemic. Never say that, of course, that it isn't systemic, but we have many symptoms. We can go over them. The redemptions are large. It's in the news every day. The core bond markets, less in the news, but are signs. The debt is slightly less than it was before. There's questions of whether the dealers have to step in more often to take up the new issuance. And the issues are very large, of course. And the big worry, Agustin alluded to it, is a combination of having buffers that probably have peaked and may even be declining, partly because of regulatory forces going the other way, partly the opaqueness. It's hard to pinpoint the risks and the core and the critical nodes in the NBFI space. The old playbook is not as easy resurrected. Debt is high on the public side, so fiscal is constrained. Monetary policy doesn't want to do this when there's inflation. And international cooperation is, of course, also under threat. So this is our lethal combination and where the perfect storm is a possibility. Let me go over the core part of the report, which is the measures. What can be done? We have a traffic light scorecard. There's things in green that can and have been done, but should maybe get a little bit more attention. Congruent regulations. We have different regulatory authorities covering a set of actions. Think of the hedge funds, the repos, that covers both prudential regulators as well as supervisor market regulators. The rules are not coherent. We should do better there. Second, stress test on the liquidity side. Without doing that on a system-wide basis, we're not going to get to the spillovers, of course. It's not within the NBFI we're worried about the spillovers to the banks. And we need to cover that with a stress test of the system. We also need to do better on institutional infrastructure. It's been an issue for the US, at least for quite a while. Central clearing, all-to-all trading, improving that will give us a more robust system with less systemic consequences, better netting, better reduction of risks. Lastly, there are issues to do preventive on the leverage side. If we have haircuts of 50 margins of 50 basis points only for hedge funds, if we have the CCP setting margins that are too low and then suddenly get adjusted in the cycle, we create procyclicality and add to stress rather than reduce it. And as Klaas mentioned, the regulatory agencies should consider the systemic risk, even if they're security market regulators. This is on the liquidity side. On the leverage side, there's more green because, in some sense, maintaining what has been done traditionally, counterpart, exposure limits, making sure you supervise your banks, but also your prime brokers, your insurance companies, that increasingly actually have extended links to the private credit and equity space, and also been raising funds from the retail investors. These are issues that are core part of your normal bank supervision and regulation that should be maintained. In addition, the stress test should also be done on the leverage systemic-wide, so the whole system should be reviewed, including, like I said, insurance and pension. And lastly, and this is more difficult, but nevertheless necessary in our view, is to think of the cost of financing. There is still the paradigm, we stop with dancing until the music stops. And that means that the cost of financing is always too low to hedge funds, to part of the NBFI. We should internalize this externality by raising that cost to some extent. There's preventive to be done in other spaces as well. But let me talk about remedial actions. Remedial, I think we've come to an agreement, when I say we collectively, the central banks, that open-ended asset purchases are probably not the best way to deal with these liquidity spillovers. We should try to avoid them as much as we can. In order to do that, we have to step up more on the international liquidity facilities and swap lines. And NBFI is a very internationally active field. And without thinking of this on a global basis, we're not addressing the liquidity shortages that come from time to time. Last part on liquidity is thinking hard about facilities that can reduce incipient stresses. We don't want to wait until it's too broad, the stress, and it spreads and contagion takes over. We want to come in early. That requires some facilities that deal with specific NBFI agents that come with a quid pro quo of regulation and oversight and budget type bank land of last resort rules implied. On the solvency side, I think most is in the buffer sense, and it's well known. There can be greater burden sharing between the public and the private sector when there's recovery. There's still a tendency to assume the public sector will come in to solve. The other things that can be done preventive, data is a key issue. It's been very difficult to get the same kind of data as we have for banks in the non-bank space. But there is quite a bit of data out there. It's often the sharing of the data among supervisory agencies nationally as well as internationally. And it's also the disclosure that is still limiting market discipline. Monetary policy and fiscal policy also have a role to play to internalize the risk-taking and reduce, as a consequence, the buildup of vulnerabilities. This is not an easy issue, even on the banking. We can go back to 23 when we had the SVB stresses. There was an interest rate increase, but the financial stability consequences were not fully internalized, and SVB and other banks ran into trouble as a consequence. We can hopefully do better on the non-bank space. And remedially, when we have to intervene, it's going to be a difficult task to communicate when monetary policy is trying to tighten, when at the same time we have to give asset purchases and liquidity for financial stability reasons. So to the extent we can communicate better, that would be useful, but also we need to think better of how we can create facilities that deal with these risks more and conflicts more explicitly and have a careful design of those going forward. Let me stop here and pass back to Melissa for your Q&A. I'm looking forward to that.
Thank you, Mr. Claessens. We will now begin the Q&A portion of the webinar. We have one question already from Advance. Do you expect the current rush to redemptions and falling asset prices in the private credit segment to lead to systemic events? Are there specific interventions that can be useful now in the middle of the turmoil?
Well, I mean, let me start by saying that there are some factors that might make us think that most likely this will not necessarily lead to a systemic crisis. But what makes this a difficult call is that we don't have full visibility of all the interconnections that are present. And that's something that we highlight and we stress a lot in the document. There are many aspects of private credit that we suspect that are not working necessarily well. An important part is the concentration of credit risk. I mean, a lot of what has happening has been associated with the concentration of software credit risk in private credit. There are some risks that are there by design, and that is the fact that you invest in non-liquid assets. And another aspect that is well known is that it's very hard to market the assets on the funds immediately. In some cases, many of the asset quality assessment is done also by private rating agencies, and sometimes it's not very clear how this is done. So there are many question marks, many question marks out there. We also don't have full clarity of the lending that has gone from commercial banks to this sector. And in addition, there are many contingent funding out there that we don't know how much has it been exercised or could be exercised in the future. I think an immediate lesson that one can extract from this episode is that to sell this type of assets, as a matter of participation in these funds, where investment is being made in very illiquid assets with the promise of higher return, is very difficult to conduct for retail investors. It's not easy to assess. I mean, normally is for retail investors is not easy to assess all what needs to be done to make a really solid financial decision. But even more in this sector, where by design at the outset we know that there are things that are difficult to assess even for experts. No. So again, as a I would say informed guess, I would say that that it's very unlikely, but there are question marks, and hopefully we can respond creatively to this situation to prevent this risk increasing into the future. Klaas, Stijn, please complement.
Yeah, I'd like to add that in part, of course, the answer to this question also depends on how you view the redemption gates, right? I mean, will these gates hold or not? It's the redemption gates that probably sets the NBFI or the asset management space, or the private credit space, I should say, sets it apart from, let's say, the banking crisis that we had in 2008, 2009, where you have sort of fully flexible, fungible liabilities. And the main difference is, of course, that in this private credit space, there are redemption gates. You cannot sort of take your money out as easily as you can take it out from the banks. But I do think that there are, even if you cannot reduce your exposure as an individual investor by getting out of a fund because of the redemption gates, there are, of course, other ways around outside the fund structure where you can put pressure on similar asset prices, take a short position elsewhere on assets that are similar to the ones in the fund which you cannot get out of, And therefore, there can still be, I think, some of these redemption pressures and still be some pressures on sort of forced asset sales outside the fund that can have an impact of pricing, and that to some extent can also become self-sustaining. The area is inherently opaque. That is always a weakness. What do we know about the way ratings have been decided in the area? We just can't check them. It was an asset class that I think was particularly fitted to sophisticated investors. But what we've seen recently is that there has been increasing outreach to retail investors, for which you can really question whether this was a fitting asset class or no. And thirdly, so far, it's been, of course, a fair weather asset class. I mean, it's an asset class that has performed because all assets were performing. But what if the credit cycle turns? And will we then get sort of the same, pro-cyclical, let's say, dynamics that we so painstakingly try to push out of the banking sector by increasing the amount of resilience there? We don't want to see that come back through the back door of private credit. And I think these are legitimate questions to be asked. I think there are some reasons not to be as alarmed as we were in 2008, 2009, because this differential structure of the liability side. But I still believe that there is enough to worry. What is the quality of workout procedures? Are there distressed debt sort of procedures within these funds when the credit cycle were to turn and asset quality were to deteriorate? I think these are legitimate questions, and therefore the recommendations in the report, I think if they were to be followed up upon, I think we would have lots or less to worry about than we currently have.
Nothing from my side to add. Thank you.
Thank you very much. We have a question from Heinrich. Heinrich has asked about waterfalls as seen in the diverse forms of securitizations in the global financial crisis. Are we seeing this now in the transactions, products, and on or off balance sheet exposures of NBFIs? And following on that, to what extent do gaps in data availability and regulatory coordination hinder the identification of associated systemic risks?
I mean, if I interpret the question correctly, there's a lot of compounding of leverage in the NBFI space. And like we said, it's not always easy to observe. And that creates, in some sense, the problem of what he may allude to, the waterfall, that you suddenly see a trigger and that actually amplifies the risk going forward. And the cascading of the leverage starts at the operational side. We have risky funding structures operationally. I mean, these firms in private credit are meant to outgrow the rest of the industry forever, and that's of course on the average not possible, but that's the presumption in that industry often. And then you get a little shock, as we have been observing more recently, that triggers the income, and that cascades them through the system because those funds are refinancing themselves with other forms of financing, and then eventually may even reach the banks. And it's that cascading, I think, what he's alluding to, that is very difficult to predict, but creates a very fragile liquidity, fragile funding structure, as we just discussed on the private credit side. So transparency would help a lot for the industry as well, because the industry doesn't know who holds what, where, and how. So as a consequence, you run for the exits whenever there is a sign of risks. And that is the problem we face at the moment.
Thank you very much, Mr. Claessens. Our next question is from Greg Quinn at Market News. Why not recommend that we regulate non-banks like banks if they are going to take on this much lending and market activity, and in particular, their participation in sovereign bond markets? Or why offer NBFIs any central bank liquidity at all to avoid a moral hazard problem if they remain unregulated?
Well, if I may, on the first part of the question, I think it is essential to always keep in mind that the concept of resilience is fundamentally different in a bank and in the non-bank space. When you talk about resilience of banking, it is a lot about solvency. And yes, it's also about liquidity. But clearly, the way we strengthened resilience was to have a critical look at risk-weighted assets, critical look at capital levels, at capital quality, and adding some macroprudential buffers on top of the microprudential requirements, etc. Such an approach would simply not work in the NBFI space because this is not just about strengthening resilience of entities, it's also about strengthening resilience of transactions. And where it is about strengthening resilience of entities, it's about liquidity management. It's about sort of trying to better manage these liquidity mismatches, to better sort of prevent these spikes in liquidity demand, becoming destabilizing and self-fulfilling. But where it is about transactions, it is all about leverage, about margining, etc. So that is a fundamentally different way of looking at the issue. Now, the second question that you sort of raise, I think, raises a number of issues. Traditionally, I can only say that central banks have always approached banking entities, which they also were quite closely involved in the licensing, as the ones through which the liquidity needed to be distributed and allocated in the financial system. It's a legitimate question whether that is still the right way to go. But I could also see quite some drawbacks from extending that safety net in a sort of unfettered way, because in my view, that would increase the moral hazard issue, and that would increase questions about appropriate risk pricing, etc., before decreasing them. But maybe Agustin and Stijn will also have something to say on this, because we discussed it also at the BIS, I remember, Agustin.
Absolutely, absolutely. No, I mean, this is a great question. I mean, I think as regulators, an issue that we face all the time is the fact that there is always many attempts to do regulatory arbitrage, you know. Yes, there is a lot of, there is particular regulation, very strong regulation in the banking system. There are many bank-like transactions that can be done outside the banking system. And of course, one of the main objectives and missions of regulators is precisely to try to prevent that arbitrage, you know. First of all, because if you don't do it, then the objective of the regulation is not being fulfilled because the risks are out there. And of course, it weakens the banks or the institutions that are fulfilling the requirements of the regulation. As a matter of fact, as we also document in the report, there are many activities inside the NBFI sector, within the NBFI sector, where you see a lot of this type of regulatory arbitrage. And therefore, it's a constant challenge for authorities to keep the lines clear and to enforce it. I would say that the main reasons we propose to give them access to liquidity under certain conditions is because the consequences of failure could be catastrophic. You know, I think in particular what was a source of concern for the group is the fact that a lot of transactions and a lot of holdings of government securities depend on repos and repo-like transactions with this very short funding that can disappear very, very sudden. And you know, even though there is the possibility of having a cascading effect and spillovers to other markets is huge, and therefore I think it could really take a systemic dimension, and therefore we feel that it's necessary that authorities have ways to short circuit the problems that may appear there. But at the same time, we try to emphasize this in the report. It's not just a gift to the NBFI sector. It is. I mean, I would say that we try to follow or to suggest a carrot and stick approach. Where obviously some strings attached are there to the contingent financing. The other issue is also that by experience we have learned that the way we have dealt with this today, which is by open-ended interventions in the markets, very broad intervention. Sometimes it's difficult for that intervention or for that liquidity to trickle down to the particular players that are facing problems, and therefore you create a lot of liquidity and so on and so forth with minimal or difficult impact on the margin you want to affect. So a more targeted, directed type of intervention would be more effective with less side effects. But again, this should not be just a gift from heaven, but it should come with strings attached.
Nothing to add. Thank you.
Thank you. Our next question. There's growing momentum to stress test the NBFI sector, such as recent work by the Bank of England. How far have we actually come in developing these tools? And is there a realistic path toward coordinated global approaches through bodies like the Financial Stability Board or in major markets like the US?
I think it's easier to done at the national level for the time being, and I think there are examples where this systems-wide stress is being done now. We have seen the Bank of England doing it on the liquidity side. They're doing one currently on the private credit. I've seen it for the ECB doing it to some extent as well. So it is feasible. It requires a lot of coordination and data, as we have mentioned before. To do it on a global level is definitely more challenging. I think the data would be the starting point to at least agree on that sharing. That can to some extent be done through memorandum of understandings. Maybe there's scope to have some more data rooms that are secure, anonymized, that can help. Part of this is also helping the industry. We talked about risks on the leverage side. Some of that is not observable to the industry. Archegos and Greensill were clear examples in which the banks themselves didn't know what exposures were. So the industry can help us here as well in collectively supporting this kind of work. For the time being, I think it will be a little bit more challenging, like I said, to do it globally. There was a global banking stress test done a few years ago. Maybe that's a starting point to look at least the links with going into the banking system more carefully on the non-banks. And maybe that can be expanded subsequently to looking at the system-wide globally as well.
I would just add that I entirely agree with Stijn, and that sort of taking this at the global level, I think there are still too many data issues that need to be overcome. Also confidentiality, legal mandates, and that sort of stand in the way of cross-border data sharing, etc., etc. But I think the space would already be quite a bit safer if at least at the national level we had a bit of convergence and agreement that we all do our sort of national system-wide liquidity stress tests, such as the Bank of England, such as the ECB, is conducted. So if we could sort of rely on each other, knowing that we've all done our housework, that we know if the stress sort of originates from one shock or the other, that we have been thinking internally about the infrastructure that we need to very quickly get a gauge of how the shock is actually transmitting itself through the system. What are the critical nodes? What are the critical players that we want to have visibility on, etc. If we had that at the national level, that would already, in my view, be a significant improvement. And I mean, this is obviously also something, it's an iterative process. The first stress test will never be a perfect one. So we will learn by doing. The industry will have to learn by having been subject to the stress test, because also they need to develop the infrastructure to meet the demands that are being put against them. So it's absolutely a positive. It's probably one of the very few ways in which I think we can come to a decent assessment of the vulnerabilities. So let the better not be the enemy of the good here, and let's work at this at national level and try to make further convergence here.
Thank you. We have another question. Are we building a system where risks can safely fail outside the banking sector, or one where they will still be forced to step in?
I don't understand very well the question, to be honest. I don't know if any of you have a better interpretation. I mean, I think it's very difficult well, I don't know. I mean, I guess the point I would make is that one of the issues that that concerns us a lot in the report, and we try to emphasize it, is the interconnection. And the fact that interconnections today are very, very hard to assess. And so to think of sort of compartmentalized risks clearly is very, very, very difficult. I mean, something that we would like to have is that financial intermediaries expose themselves to the risks they are meant to expose themselves, and that those risks are well regulated and supervised. But we are not absolutely sure that we are getting there. You know, I mean, there is so much interconnection that that is very, 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 very difficult to assure that the risks are placed in the right, I would say, dimension. And again, going back to what both Klaas and Stijn has reiterated, this is a very opaque system, you know, and part of the opaqueness is precisely to identify on a timely basis where the risks are. And a lot of these activities are precisely for some intermediaries to expose themselves to some very particular risks, trying to arbitrage regulation. So this is a very active game where, you know, financial authorities have to be really looking what are the new risks and how those risks are being, or how regulation is being arbitraged, exposing different intermediaries to risks, oftentimes that they're not supposed to be exposed to. So it's a challenge.
And I would say that regardless of all the shortcomings and all the vulnerabilities that we have identified in the NBFI space, in general, the NBFI space is, of course, a space that lends itself better for absorbing losses and having sort of the value of liabilities move with the volatility on the asset side than the banking side, where by definition the liabilities are harder and need to be sort of respected. So despite the shortcomings, I do believe that there continues to be a difference in the ease with which the losses can be absorbed. But of course, it assumes that we have a decent picture on an issue like, for instance, leverage, because the moment there is leverage involved in NBFI, that is where systemic risk can originate, because it limits the amount in which liabilities can be sort of downgraded jointly with the loss in value of assets. So that's why we have to work on these recommendations. But let's also not immediately put NBFI in the same bucket as banks. The liability structure is key here. It continues to be different, but there are vulnerabilities also on the NBFI side.
Yeah, I think part of the answer is also we've had a 15, 20 years of a good credit cycle, and losses have been relatively limited. And now people wake up to the fact that you can have losses from time to time when the cycle turns. And we have to resist coming in there too early, because this is the way the private sector is supposed to work. You have to be willing to absorb loss from time as well. And I think we're at that inflection point, probably.
We have time for just one last question. What is the role of credit rating agencies in providing data? How do the private sector and organizations such as the Financial Stability Board play a role?
Well, there's two questions, I think. But on the credit rating agencies, I think they suffer from the same problem that we've been alluding to, the opaqueness. And actually, they've been substituted now by private ratings, meaning non-public ratings that are internal to the industry, which of course distort because one cannot verify the way they're constructed, nor we see them. And if you self-mark your own book, that's not the way to be transparent. So that has to be fixed, and I think people are waking up to that deficiency in the industry themselves, but it can be supported by regulatory action as well. I'll pass the question on FSB. I don't see a direct role, but Klaas will know better.
No, I really think you captured it quite well, Stijn. Of course, what the FSB has been doing in the past is also issuing recommendations on sort of the processes and the due processes that credit rating agencies should observe when arriving at the ratings. The problem here is obviously that these ratings are private, so it's very, very difficult to sort of verify whether these procedures have been upheld and to check the validity of the ratings, which is already in public capital markets sometimes a bit of a stretch. But here, it's the inherent opacity, it's the inherent illiquidity, for which in good times, of course, investors also pick up an additional return. But if the tide turns, then it is an additional source of risk. And I think also an entity like the FSB would not be able to do a much better job in terms of the substance of the ratings, but the process with which ratings are being constructed should obviously also be observed in the private space than in the public space.
Unfortunately, we've run out of time for more questions. We would like to thank our speakers and all of you for taking the time to join us today. Goodbye.